Thanks for clicking. A growing number of Canadian mortgages have amortizations over 30 years, according to a new report published by the Globe and Mail. According to the report, as a result of a growing number of Canadians with variable rate mortgages and fixed payments hitting their trigger rates as the Bank of Canada continues to raise interest rates, RBC, BMO, and CIBC have seen a major increase in the number of borrowers extending their amortizations over 30 years.
Everything's cool right now. Might be some problems later.
Indeed, in Canada, at least on the A side, on the prime lending side, we don't have 35, 40-year amortizations, and for very good reason. It's risky. The report comes amid a growing number of articles warning of the risks to holders of variable rate mortgages with static payments, with the Bank of Canada continually raising interest rates and thousands of mortgage borrowers about to hit their trigger point. That is, the point at which the bank renegotiates the loan or extends the amortization. So what I want to do today is very briefly go over what the trigger rate is, discuss why and to what extent RBC, BMO, and CIBC are extending their amortizations, go over some implications of these longer amortizations, and then discuss what to look for next. Next week is a big week for financial news as we're set to receive Canada's national real estate data for the month of October, and we're also expecting Canada's inflation rate for the month of October, which is going to be released by StatsCan on the 16th. We'll obviously have updates out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these trigger rates. Very quickly, as we've discussed this before on this channel, the trigger point is the point at which holders of variable rate mortgages, those with static payments, reach a point where those static payments are no longer enough to cover the interest portion of the loan. So let's say you bought a house in Canada in December of 2021 when the benchmark price of a home was $812,000, the prime rate was 2.45, and a decent variable rate mortgage was prime minus 0.85, giving you an interest rate of 1.6.
I'm forever in your debt.
At that point, your mortgage payment would have been about $3,000, with $2,000 going towards principal and $1,000 going towards interest. However, prime has now bumped to 5.95, making your interest rate 5.1, and that $3,000 no longer covers the interest that is due, with the amount of interest on that 5.1% being $3,177. At this point, your bank has a number of options, and although this does vary across lenders, most banks will either automatically adjust your payment. However, the RBC, CIBC, and BMO extend the amortization, increasing the amount of time it takes to pay off the loan so that your monthly payment is enough to cover at least the interest. In this extension of the amortization period, the amount of time it takes to pay off your mortgage is what's happening at RBC, BMO, and CIBC right now. According to recent filings, the number of mortgages that exceed 30 years has doubled. As of April of 2022, about 10 to 12% of the mortgages held by these three banks had amortizations over 30 years. However, by July of 2022, that number had bumped up to about 25% of all of the mortgages held by these banks. And while this isn't a problem right now, not right this minute, it does raise some serious issues for the future. First, while right now these banks are just extending the amortization, extending the amount of time these borrowers have to pay off their mortgage, at the end of their current term, that mortgage snaps back to its original term, which will trigger a major increase of payments. The original payment we just looked at was a $3,000 payment on a 5-year term with a 25-year amortization. Now, at the end of that term, the bank goes to renew that mortgage. There are 20 years left on that mortgage. Renewing at 20 years with a 5.1 interest rate would lead to a payment of around $5,000. At the time of renewal, if those borrowers wanted to extend the amortization back up to say 25, 30 years, those borrowers would have to requalify at the new stress test at 5.1 plus 2%. So they would have to requalify at 7.1%. Otherwise, they have to stick with that 20-year amortization.
Not always.
Now that's obviously just one scenario, and it will depend largely on how much of the loan has been paid off over these past 5 years. But if the amortization has been increasing to over 30, over 35 years, then that principal has not been paid down by a whole lot throughout the 5-year term. But it's not just an increase in payments that are problematic, it's a lack of flexibility. That benchmark home that we just discussed that was purchased December of 2021 was purchased for $812K. And according to recent statistics from the CREA, it would now be worth about $766,000 with many predicting another 15% drop over the next couple months. So if it comes time for renewal in, say, 2026, and we haven't seen a big reversal in house prices, if house prices have not returned to those pandemic highs, to what we saw in July of 2021, then that home buyer is not going to have a whole lot of equity in their home. And that's going to make it even more difficult for them to shop around for a better mortgage rate. If they don't have the value in their home, another bank isn't going to take on a home that is underwater, where the homeowners owe more on it than the home is actually worth.
See, someone has leverage.
So this gives a lot more leverage to the banks, to RBC, to BMO, to CIBC when the homeowners come up for renewal. If their homes aren't worth what they owe on them, they are not going to be able to shop for a better rate. They are going to be basically stuck and have to take the mortgage rate being offered by their current lender. Now, all of this is based on the idea that the Bank of Canada over the next couple years does not reverse on interest rates, that interest rates don't go back down, so these holders of these variable rate mortgages with static payments don't start paying off more and more of their principal again. That prime won't reverse, won't go back down, and these homeowners won't be able to stop paying more of their principal off. If the Bank of Canada were to reverse on interest rates over the next couple years, if there was a big recession, or by some miracle they were able to get our inflation rate back down to that 2%, ideally 1.5% if they're going to be reversing rates. If our inflation rate goes back down and the Bank of Canada can lower rates, then these holders of these variable rate mortgages with static payments will see it go the other way, where they start paying off their principal again and the mortgage amount starts to decrease. Whether or not this will happen anytime soon remains to be seen, but the report published by the Globe and Mail looks at the data from the big three banks as of July, and the amount of mortgage borrowers they had with the amortizations over 30 years had doubled as of July. So more and more borrowers have no doubt hit their trigger rates since then, since the Bank of Canada raised interest rates by 125 basis points since the time of these filings back in July. So, unfortunately, as of right now, the data is probably worse than that which is being reported by the Globe and Mail, and we'll probably see even more borrowers hit their trigger rates as time goes on. With that said, we will continue to track the housing market here in Canada and the impact of these rising rates on that market. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.